2025, massive rally in gold, silver, and even copper in 2026. Which asset class are you more bullish?
I just came back from China, and what I saw in auto there is something which probably will happen in India in the next 5-10 years.
What's your view on hospitals in India?
Indian healthcare is probably still the cheapest in the world. You will only see escalation of those prices. India is definitely the most consistent growing country in the world. If I were a buyer, 2026 is a fantastic opportunity for me.
Your first stock, did you make money? Did you lose money?
No, I lost money terribly.
Today's guest is Mr. Swarup Mohanty, Vice Chairman and CEO of Mirai Asset Mutual Fund India. As all of us know, the world order has completely changed in 2026. So our portfolios also need to align to the new world order. So in this episode, we are going to explore various topics. For example, gold. How much should be gold in our portfolio? Indian stock market, when is likely to be the next bull run? How should we align our portfolios according to what's happening in the Indian stock market? What should be the good asset allocation for 2026 and beyond? This episode is going to give you excellent perspective on 2026 and beyond. Humble request that you subscribe to my channel so that I can continue to bring such content to you at zero cost. Hit that subscribe button now and let me know in the comments a simple thank you. Enjoy this episode. Saurabhji, thank you so much for giving me your time today. I know you've been in market for almost 30 years now, if I'm not wrong. 30 plus years, right? 2026. Let's talk about 2026. There are a lot of questions in my mind, right?
In everybody's
I'm sure. Because a lot of things have happened in 2025 and that makes you nervous and also excited in my view because we are talking about future now. So in 2026, given the massive rally in 2025 in gold, silver, and even copper to a good degree, which asset class in 2026 are you more bullish?
See, I think since you mentioned this, for me, 2026 is like taking a fresh start in investing.
Right.
My personal opinion, and I hope I'm wrong on this one, because then portfolios need to be rejected at a very different level. Everything that worked till 2025 starts afresh in 2026. The rules behind every asset class that we invest in has changed dramatically. I'll give you 2-3 simple points. I mean, when you look at the listing in the markets, the listings in the last 2-3 years have been more in the mid and small and have introduced new industries into the market. So the erstwhile thought that the core has to be more large cap. Just to own the breadth of the market, you have to invest more in mid and small. So the allocation to equity stands changed just to catch the length of the market. Mm-hmm. When you look at this simple data, and in 2008, I think the great Warren Buffett had simplified it for me, saying that dollar is the trading currency of the world. But now when we stand in this staggering data, that gold reserves at a sovereign level are higher than dollar reserves, that statement now stands altered. Right. The dollar is changed. So when you look at gold as an asset class, I do not know what is the trigger for equity in 2026, but I know for sure that till this volatility is there on the geopolitical level, sovereigns will continue to buy gold. Right? So the way that same metal was behaving is very different from 2026 onwards. Third, I think, when you look at debt as a third asset class, due to the geopolitical nature, a lot of action has already been taken on interest rates and the way central banks view that asset. So the way you perceive debt till 2025 can be a little different. So the point I'm making is when you are looking at building a portfolio, you have to take all these three into account and behave in a very contrasting manner than what used to. That proverbial mutual fund saying, past returns need not carry on for the future. They stand absolutely true from 2026 onwards. So portfolio reviews have to be completely with a new set of rules.
So if I were to pick up the points that you described there, so 2026, what you're saying essentially is that gold is likely to be, you are bullish on gold, right? There should be more money flowing into gold.
I see more consistency in gold. Behavior in gold.
Yeah.
See, I'm never bullish or bearish.
Right.
There's a percentage of your allocation which goes to a certain asset class, and that allocation is what it should be fulfilled.
Sure.
When you look at that fulfillment of that asset class, I see more predictable or consistency behavior on gold than any other asset class. Probably debt also at a bearish level in 2026.
So just since we are on the topic of gold, I was watching your interview. I can't remember the channel name. And I think you said that gold could be considered now as an asset class that could take up to 30% of your portfolio allocation, right?
I'm not saying this.
Right.
If you see the RBI data on financial assets
Sure.
of any individual, this is the average, this 2023 data, I think. It says that an average Indian on financial assets, non-real estate financial assets, has 30% in bank FDs,
Sure.
32% in gold, 10% in equity, which is now gone up to say 14%, and the rest in retirees. The person is anyway owning that much of gold. My whole thing is gold that is there in the locker is useless.
Right.
It should be owned digitally.
Okay.
I mean, a lot of parents and Indians have been traditional gold buyers and then keep it for future use. That future use, instead of using a bank locker in designs which will not be used when it comes to that day of a daughter's marriage or a daughter-in-law coming to the house. These are two primary these things, or just for wearing. I think if you want to wear it, please flaunt it. But the gold which is stored should be stored in the electronic format, which is either through the ETFs. That's my preferred way. But that's point number one. Point number two is when you look at the behavior of this asset class in the next 2-3 years. Earlier, gold was considered a hedge of a portfolio. But when you look at 10-year data of gold outperforming Nifty 50, then you need to rethink that whole thing.
Right.
These are 2-3 points that I want to make. So the point number one is it cannot be considered a hedge in the portfolio anymore. It is pure investment grade because not only us, the sovereigns are buying. And it's a commodity. It's completely dependent on buying and selling. If you see consistent buying, the price will impact it on a positive manner. That's where I come from. Whether it's 20, 30, 40% is up to the person to decide. But it cannot be that 8-10 proverbial discussion that was there on the table earlier.
Right. So from low allocation, people could potentially look at it like a larger allocation.
Yeah,
in
people
gold.
have allocated. See,
I mean, not everybody, because I know our grandparents, for example, or my parents, right? Gold definitely was one of the primary asset because at the time, let's face it, there was no electronic, demat accounts, for example, right? And people did not know how to invest in stocks or mutual funds, right? Now things have changed drastically.
Yeah.
And more people want to participate in the story, be it the mutual fund story or the gold story or the silver story, right? So now the allocations, as you rightly said, needs to adjust in 2026. And what I am gathering is that you're leaning towards. Again, I'm not saying, and I'm not holding you.
No, you can hold me.
To say that 20%
because for the
of
last 20-25 years, there has not been a single discussion on any investor education forum where I've not mentioned gold.
Right. Okay.
Okay, and then since you mentioned your grandparents and say the parents holding gold, here's my caveat to the whole thing. When you look at the demonstration of behavior that say your parents or your grandparents or my generation has shown towards gold buying, it's been an incredible behavior of discipline.
Right.
Nobody bought gold because of the price till now.
Mm-hmm.
People bought gold to accumulate. We had one SIP date in a year called Dhanteras or Akshaya Tritiya, and we religiously went and bought it, right? And it was bought to be held. It was not bought to be sold.
Right.
It was that safe haven. And you put this behavior to any good asset class, you are bound to make money, right? Now what's happening is very contrary to that. And here's my fear. This entire incredible behavior shown by 3-4 generations, or the ability to accumulate a great asset class, I call it a great asset class because it yielded returns, right? Now stands to be spoiled by guys like me and coming and teaching them returns on this asset.
Right.
Instead of accumulating, my fear is it can get into timing.
Okay.
Which is the equity form of behavior. If people would have held equity the way they would have held gold, their experience would be dramatically different, right? But 1.5 years of the markets going this way,
people
there
are
is a
screaming
discussion
out.
Are very different. I don't want that same discussion happening with this incredible behavior of investors.
Right.
And that's my fear. If you continue accumulating that asset class the way you did, irrespective of the price, and trust me, Anytime you gone and bought gold in the last 20, 30, 40 years, it was always expensive. Nobody has bothered. Correct me if I'm wrong.
No, you're right, absolutely right. Whenever you go and want to buy it, you feel like, you know what, it's costly.
I got married in 96, it was 5,400. I found it very expensive. Compare that to today. What are we talking? But the point I'm making is no Indian has gone and bought gold keeping price in mind.
Acha.
And that stands to be on the cusp of being changed. And that could lead to a different behavior to accumulation, which may not be the right form of behavior, is my submission.
Okay. No, understand it. Totally get your perspective on that. Let me now come back to Indian stock market.
Yeah.
So 2026, I want to get your perspective on, let's say, top 3 sectors where you think there could be a better risk-reward ratio, if you like, and more attractiveness.
Yeah.
What are those top 3 sectors or
I
themes?
think I liked your question on being risk reward
Right,
at
sure.
the end of the day. See, the world is not what it was. And at this moment, there are too many questions without answers at this moment. A lot of loops that need to be closed. And in that adversity, see, the world earlier used to work towards working with each other. It's a polarized world now. And then behaviors across economies, across countries are changing. And when large economies change their behavior, the rest of the world also is bound to follow suit. In this entire adverse world, it's always good to stick to the core
Okay.
and stick to the boring at this moment till some answers come. So I don't think, and it's a personal opinion, many of these answers will be answered in 2026. In that thing, I would definitely stick to the core, and the core or backbone of the industry or the economy will always remain financials. We like the broad financial diversity. I'm a big fan of the capital market index.
Okay.
And it's an ecosystem which is being formed. And then when I started my career, say if you go back to the mutual funds, say in the early or mid 90s, our balance sheet would read banks, or a fact sheet would read bank, then we can bank NBFC, then we can bank NBFC financials, now it's bank NBFC financials fintech, now it's bank NBFC financials fintech payments.
And insurance as
And
well.
insurance, all that is growing, right?
Right,
It's
right.
an ecosystem which will only grow. And if the economy has to thrive, this has to thrive. So
Right.
this is the core. I think India has a perpetual consumption economy. And what is happening is a low and mid-level consumer is getting converted to a mid and high-level consumer. So consumer discretionary is perpetual in India. And it's got re-rated post-COVID. I had thought people will come out of COVID a little conservative, but they went the other way. And it's always, the wisdom of the crowds. So when you see that trend happening, I think consumer discretion is something which I'll put as number 2. And a little boring, but if you track any consumption fund over the last 15, 16 years and compare it to a flexi cap, you yourself will get an answer on risk reward versus Sharpe ratio.
Okay.
Everything. Just do that homework yourself. The third most important, I think we are seeing a very interesting run in auto.
Auto. Okay.
Though that auto, my personal opinion is, again, I just came back for 15, 16 days in China. And what I saw in auto there is something which probably will happen in India in the next 5, 10 years. So auto revival is good for us. As a house, we believe in that story. But the fourth I will add, which is my personal favorite perpetually, is the India pharma story or the healthcare story. This story is here to, develop and unfold in the next 5, 10 years. You will see a lot happening. And that's a core which I always hold. And I'm a big fan of healthcare perpetually in India.
Thank you so much for giving me those answers. And I have a lot of questions now. Okay. And I'm not going to let you go easy, right? I'm going to ask you these questions. It may make you uncomfortable, but so be it, right? Yeah. You said financials, you said core, right? So in banking, specifically, do you have any view on private banks versus PSU?
We've always been overweight private banks.
Overweight on private
banks.
Okay.
And some of it unfolded this year.
Right.
But now we are probably graduating it to the new age banks also.
Okay. Examples, any? Or
I'm not allowed to take stocks, but some of these new digital banks which are forming, watch out for the digital infrastructure that is happening or unfolding in the country. Whether it's banks to some insurance companies, that entire Maybe it'll take some time to develop, but that's where it'll go.
Okay.
A lot of capital light businesses on that side needs to be watched very carefully.
And you also talked about the capital market
Yeah.
side of the business. There also, which segment? Is it the broker side, or do you have any view around within
Look
the
at
capital
us. I
market?
think AMCs are a great story, right?
AMCs, okay.
Yeah.
But I in AMCs, recent SEBI's interventions, or rather tightening on the fees, etc. How does that play out in AMC business?
Not only AMC, in any story, when volumes rise, when industry grow, cost will always be a discussion.
Sure.
So why should we be an exception? And especially in our business, which is fiduciary, which is somebody else's money, the cost should always be discussed.
Sure.
And if there is any scope of efficiencies in cost, which is our selfish interest in the service of the investor, we carry that fiduciary, we should do it at the earliest, maybe yesterday. So that's a discussion which is perpetual. And I'm part of MFAC also, which then gives me a broader sort of worldview on why this is done. And then it's the regulator's job to be always on the investor side.
Right.
So anything that is right for the investor is right for us. That's
Okay.
the only rule of our industry.
Sure.
So that's something which is a given. So we should always welcome that.
Okay.
So in spite of that, look at that. I mean, look at the growth in some of the AUMs that have happened, and the efficiencies in managements that have followed. It drives us to be more efficient, right?
Sure.
But financialization of assets are just about happening. This 80 odd lakh that the industry is carrying from an AUM to GDP is always one of the lowest in the world. And in a country which is so young, and the young are financially more secure, knowledgeable, they will take to financial assets more than, say, my dad did.
Sure.
So the future is just one way. And in that, if you are sitting with more efficient framework, the quantum of money that can come in will only offset this.
Right. And also you talked about auto. In auto, are you looking at two-wheelers, four-wheelers, or across broad base?
See, like I said, it is re-rating of autos. Every engine is getting reworked. Science is moving from... See, look at it in perspective as to, let's go back to that 2026 whole thing. The two big growth factors or impact factors on any economy was oil and was also the dollar, right?
Right.
Currency. Both are changing behavior. And today, India is selling the number of EVs it can produce. There's no inventory in EVs. Slowly but surely, when the EVs increase, the dependence on oils will also decrease. So that's a change which is happening. So when you see those changes, those balance sheets will incorporate these changes and sit more in tomorrow than today will benefit. Whether it's two-wheeler, look at the same two-wheeler. I used to own both the companies. Those days, there used to be this Bajaj and LML. I used to drive both those scooters, right?
Sure.
Look at the bikes that were there and the bikes that are there today. Very efficient on energy and more climate friendly than they were. So that entire industry is getting re-rated. More than auto, because now any car or any auto is more electronic and more, science than just mechanics. The entire ancillary space has widened.
Right.
It's no longer somebody making a spark plug or a carburetor that drives just an engine. It's the whole science, electronic part of it. And then mostly you buy a car for the gizmos that come than the engine. The car seller sells you more gizmos than the engine, right?
But that's what consumers are asking for.
So then the ancillary that you will see from 2026, it's already happened, is probably very different from the ancillary you were seeing in 1990.
Right.
So the landscape has become so large that when you look at auto, you have to keep ancillary in mind also.
Okay. I quite like auto as a story. Personally, I've invested in auto in 2025 and got good benefits out of it, which is great. One risk that I am forcing right now, which I wanted to run it by you and see what you have to say on that, is how in US, Donald Trump is getting very, very close to oil. What happened in Venezuela and how he's now cracking deals with, let's say, a lot of oil companies, right? My fear on auto, although I'm an investor in auto right now, is that is the story now going to change from EVs to actually going back to oil-based, vehicles, because oil supply is likely to get increased. Trump is shutting down a lot of things on renewable, for example. He's actually changing the entire world upside down.
True.
And I see that as a potential risk, particularly for my auto portfolio. And I want to ask you, how do you see that? Do you see that as a risk, or do you think that's just a noise? Or
See, when you look at it from an India perspective, no, we are not yet in the EV race,
right?
I said I spent 16 days in China. I didn't see a single petrol or a diesel vehicle.
Right.
100 out of 100 vehicles are EVs there.
Okay.
So it's still early days for us. And then as a country, we have to decide whether we want to take that oil race or not. That's at a macro level. I'm too small a man to comment on that. But to say that we play any role, very significant. How many people do you know who own an EV? You go into any building, you are from Gurgaon, I am from Parel here. The EV vehicles or the green number plates just shine out. They're not like everywhere.
So you're saying the
We're still
penetration,
isolated from
within
that race.
India, we have a different story here.
I hope we were more.
Right. Of course.
But I don't think that is yet to impact us as much as it should.
So maybe the global car makers, right? Where, again, I don't want to take the name of the companies, but we know companies that are producing EVs and the SUVs, etc., for global market. There might be a slight impact or a risk.
No, huge impact, not for us, right?
Right,
I
okay.
think most of them are geared up.
Right. Okay.
If you look at some of the German car makers coming out from Pune, they're already manufacturing more EVs than this side. They're sitting on both sides, right?
Right.
The only place which can be impacted probably the Chinese makers, right?
Right.
Which are sitting completely on the other side. But if you look at China, their own consumption is big enough for them to carry it through.
Right. My last one, and I promised you I'll move to next one. On pharma side, you said pharma still is a very good story that is still being developed. Healthcare, if I look at a broader segment of healthcare, what's your view on hospitals in India? Because there's a lot of talk on hospitals as well as a long-term theme,
See, in the early 2000s, a very dear doctor friend of mine had told me the penetration of insurance will define the growth of healthcare. Think about it. Penetration of health insurance. And today, if you're not covered, a lot changes for you in medical services that you receive. And that's the beginning of the story. And dare say, I think the post-COVID, the cognizance that you should own a good cover and not a cover which is floating in nature, it started seeping into many people.
Right.
And to seek cover beyond your organization's cover is also an education which needs to get more deeper. And I encourage people to, I'm a mutual fund seller, but I sell more health insurance, I feel, whenever I do any talking. I would really encourage you to talk about it because finally health is everything, right? And health situations are changing lately. And I'm sorry I have to say this, but the number of people who are suddenly being hit by a heart, breakdown or whatever, it's just on the rise. There's no science to prove that, right? When you look at that entire story and you see the penetration of hospitals or the availability of number of beds, we're still way behind the curve. Thankfully, the need to do that has come up because finally the hospital is also a business. And people need to spend money for those hospitals to be able to afford those machines that are there for you to be served with, right? And I think they will go hand in hand.
Right.
My personal opinion is general insurance or medical insurance is on the rise, which will then give, of course, the state is covering a lot of it now, right? And with all this combined environment, you will see this only growing.
Right.
Even having said that, Indian healthcare is probably still the cheapest in the world. You will only see escalation of those prices, but it will coincide with this penetration, is my view. So when you look at 8-10 years later, the need for medical hospitals education is also needed. From that to the combined ecosystem of pharmacies going public, to chemists looking far stronger than what it is now, to pathology now developing into a full-fledged specialized area. We are beginning to see some of them, some pathologists becoming countrywide names and building reputation just through pathology, right? And of course, the higher for sort of medical requirements on the more expensive. I hope people don't use it at the end of the day, but the provision has to be there. And then 10 years later, anybody who sits in that particular segment is just going to see an upside.
Okay. So it's like a long-term theme.
It's a perpetual growth. So it's a no-brainer actually.
That was very, very good. And I got very clear answers, Swarup. So thank you for that. I also want to check with you in terms of large cap space, mid cap and small cap. In 2026, where is a better risk reward ratio according to you?
So I've stuck my neck out on the mid caps
Right.
at the beginning of the year.
Okay.
2-3 things. I think if you look at the last 2-3 years, I think the mid caps have held good, and have shown excellent resilience the last 2-3 years, and purely from market cap perspective to earnings perspective.
Right.
Finally, it will follow earnings, right? And more important, when you look at the flow of money, in the last 2-3 years, they're dramatically underowned. Money has gone more to small caps, and erstwhile money was more in large caps. So I feel from a portfolio perspective, it is dramatically underowned, and it's missed some of these glamorous returns that were put up by the small caps
Right.
or
So-
gold recently.
Okay.
So from a portfolio allocation perspective, I think 2026 should belong to mid caps.
Mid caps. Okay. That is very, very clear. So thanks for that. If I look back, September 2024 is when the correction started in Indian stock market, if I remember it correctly,
Yeah.
right? So it's been like 16 months now almost. Going forward, what are the chances? And I do not know, and maybe nobody really knows, but what are the chances of we getting the bull run in India? And what are the top two, three factors that needs to be in place for the next bull run to start? And if you have any timings, it could be, I don't know, even 27, 26, 28. When could we see the next rally? Because everybody is now, including me, looking forward to that, at least some sort of movement in the stock market. We see portfolios coming back to green, and ultimately we need to get a smile on our faces, which has been lacking for almost 15 months. So what you have to say on the bull run?
So let me break down the last 25 years of, say, the Nifty 50.
Sure.
If you look at, say, from 2020, it would have taken 6 to 7 years to double.
Right.
The next doubling also happened in 7 years.
Right.
But then we got this incredible opportunity of this market crash in COVID, which created this aberration of a low. And then it tripled in 2 or 3 years' time, right? If you look at the last 1.5 years, it is showing signs of reverting to that original mean of 6 to 7 years Nifty 50 earnings, because the base is now very different, or Nifty 50 double, sorry.
Right.
So I would say first is to mitigate the returns expectation. That's point number one, because it is going back to, or sanity is prevailing, first of all, right? So this erstwhile projection of Nifty 50 or the broader market giving you returns and doubling in 6-7 years is, I think, somewhere settling down.
Right.
Second, please understand the FIs have been on an outward sort of projection, and I see continuation of that, because there's no trigger for them to be here at this moment. My personal opinion is, if you keep the Indian stock market story aside, at this moment with bond yields of 4.5 there, and say depreciation story of 3%, 7.5 clean returns for them not to invest in India. And then the market has to give substantial risk reward for them to, be attracted to this story.
Come back to India, okay.
But finally, for any direction of any market, it will only pursue earnings.
Right.
And I think we had said that at the beginning of 2025, that we don't see earnings in 2025. So the market does not have any trigger for 2025. But we'll have to look for earnings. Like, I think the autos started by surprising us. IT is looking much better than what we had thought. Some private banks or some banks have come back and shown us good results. So in pockets, we are beginning to see some revival of earnings. But we don't see that happening even before the second half of the year.
Right.
Right. And then this big thing of tariffs has to be signed this way or the other.
Right.
The world one is waiting for that. Some clarity. Like I said at the beginning, some questions may not be answered this year also. Whether we'll sign it or not, it's far above my pay grade to actually even think of answering that question. So till those things do not happen, market will continue to look for direction. And this proverbial statement of it being a stock picker's market is back and back with a bang.
Right.
So if I were an investor this year, I would more depend on a fund manager than going direct in the market.
Okay.
Because cycles have changed. If you see, the stocks which ran till 2025 have not run, and people who were sitting in stocks which had not run in 2025, the performance of the funds have just overturned, right?
Right.
Funds which were sitting on the sideline last year are sitting in Q1, and funds which were at Q1 are very different. That is the cycle change, and that is why you should come to a fund manager. Picking stocks is easier than picking cycles.
Right.
And we see a dramatic cycle change here. So from our perspective, it's probably the best time to continue to accumulate equity. See, when do you buy equity, which is not in your favor? India was one of the worst performing markets in 2025, makes it very attractive in 2026. So I think from an allocation perspective, slowly but surely it is tilting now in favor of equity over metals.
Right.
And that's where it will look like the entire 2026, my opinion. If you bought a lot of metals last year, maybe this year allocation should go towards equity.
Okay. So 3 triggers, if I could catch from that explanation. One was the trade deal between US and India, if that needs to be signed off. Second is the FI's returns. The market needs to give them something for them to come back.
It can add to a trigger, right?
It could.
Yeah.
And third, you talked about the earnings.
Yeah, but having said that, see, these are all very short-term sort of discussions. There is nothing that is taking away the structural growth story called India. India, when you look at 6.5% growth, is definitely the most consistent growing country in the world in the last 2-3 decades. If you look at, say, a rolling return of growth rates, it would be the most considered decadal growth story of the world, right? So when you look at a consistent story of like that, and in the near term there are some triggers which it is awaiting. The person who looks at, I always say this, the person who looks at Sensex at 80,000 and there's a person who will look at India at 8 billion. It depends on both.
Right.
Everybody is right, it's their money. But the person who looks at Sensex at 80,000 will behave very differently from the person who looks at India at 8 billion. Whether you like it or not, India will become 8 billion. So the person who sits till 8 billion will actually capture the market.
Right.
There's this big story, that Carl Richards, investment return versus investor return. The person who sits then takes the entire cream of the asset class, which has happened in gold.
Right.
The reason we've not earned that cream is because we've not sat on equity.
Right.
Person who sits will make it and take advantages of these negative sentiments of the market.
Yeah. I think the only thing I would say is that because our macros have been good, India's story has been good.
But India macros continue to be good.
And they are still, in fact, they're improving.
From a government perspective, whether it's the government or the central bank, the reforms and the continuous watch and proactiveness of approach to the economy cannot be seconded at all. It's probably one of the best in the world on consistency, right?
Yeah, absolutely.
And from a consumption perspective, when you look at the GST cut and the change in the pay which will come and taxes, everything has put a lot of money in one's pocket. Once people see some a slightly longer term view of consistency of life, spending is going to happen. So it's just, but when will you buy? When FIs have come back, when it's already signed.
Exactly.
Trust me, in 3 trading days, market will not give you an option.
Right.
So the opportunity is before that happens.
Right. One question that keeps coming into my mind about FIs is that, okay, fine, you said that bond yield 4 to 4.5% and add 3% of rupee depreciation, right? Why would they come
That's my personal logic.
Which is fine. And I just want to understand that. So rupee depreciation, if I just talk about that for a moment, right? One of the reasons rupee has depreciated is because FIs have taken the money out.
One of the reasons.
I'm not saying it's the entire story, but definitely that has contributed in it, right? Now, if I'm a FI and if I look at India and I say, you know what, rupee is at 90, 91. Maybe this is the time for me to go back to India because
See, they are irrespective of rupee 80, 90, 100. They just want to see consistency of that. It should remain at 90.
Right.
The moment they see it going to 93 or
94 or 95,
that's when
where
they lose money,
okay.
right? They please make no mistake. They will enter at a certain price. They just want that protection of that price.
Right. I see
Then
what
the
you mean.
stock market should give them that value. They
Right.
should. This should not be creeping into the stock market
Correct.
return.
Correct.
Is the point I'm making.
Okay. No, understood it totally. So yeah, no, this is very clear. So given these uncertainties at the minute, 2026 might still be a difficult year for you.
See, there are two types of people
Right.
in the market. Okay, one is a buyer, one is a seller. The buyer wants the market to fall. The seller wants the market to go up. If I were a buyer, 2026 is a fantastic opportunity for me.
Okay.
You decide who you are.
Right.
I'm not in control of you.
Sure.
But if I'm a buyer and I see India at 8 trillion, and if the money start coming, I would rather buy it before the money start coming.
Okay.
Because when big money is coming, trust me,
You don't get a chance to get in.
there's this simple saying: if you support the market in its own bad days, the market will come and take care of you in its good days.
Right.
That applies to a good fund manager also.
Right.
If you support a good fund manager during his or her bad days, he or she will come back and take care of you in his or her good days. So it's these are not exactly bad days. Market has support of 30,000 crores only from SIPs in the industry.
Well,
So-
that's what has been holding it so far. Otherwise,
but
would she
see, it's a good thing to say, but the market needs all types of monies. To say that this will replace FIs is a very frugal or frivolous statement is the right word. We need that money. We need this money because the approach of that money is very different from the approach
Yeah,
of
of
this
course.
money. Once, and I'd like to leave behind one to all your readers, when earlier this market was held by institutions. The risk of the market belonged to the institutions. Slowly but surely, that risk is being shifted to the retail investor of the country. So the retail investor should now educate himself or herself of owning this risk. Now, when you start investing, you think this is a return generation process. But as you mature, you realize it's a risk mitigation process. The more you understand risk, the more opportunities you then find. So there are two sides to every story. It's great to have 30,000 or 40,000. I'm sure it will become 40,000. But then the risk is also changing, or the
Right.
ownership risk is changing, and that we should be cognizant of.
Brilliant. No, thank you so much for that. That brings a lot of perspective and some positivity, hopefully, that it's not all
as
doom
an
and gloom.
investor, I'm very happy.
Yeah.
My SIPs are getting
This is a good time to-
NAVs,
yeah.
and it's continuing to see. The moment it reaches 8, I want it to accumulate. I want the country to go from 4 trillion to 8 trillion in 1 year, so
Right.
that I'll accumulate till that time, and suddenly the compounding will happen before that.
Right.
So till that time, if my money is accumulated at this price, I'm extremely happy.
Brilliant. Thank you. I know we are short on time. I just want to ask you one last important question, which is quite important actually. People in 30s, that's where, earnings starts to come in and we have family responsibilities at the same time.
Correct.
What should be the ideal asset allocation for a long-term person, right? In terms of metals versus equities and debt and whatnot. What should the ideal or a practical rather?
See, first of all, this whole process is called personal finance
Ji,
for a reason. Because it is personal to every person.
correct.
Everybody's life is different. Everybody's life goals are different, and everybody's right in that. So first, if the young person were to define life or try to charter the life in the way he or she wants to do, that will do a lot of good to investing. So you have to know why you are investing. Fix your goal. The goals can change. Portfolios can change with goals, but fixing a goal then defines everything. If I want X in Y years, then I will know how much money I want.
Mm-hmm.
From that number of years comes a certain return. If my return is 7%, I might as well invest in debt. I don't need to invest anywhere. But if the return is 11, 12% or 13, 14%, then you have to graduate towards different asset classes. Because every asset class has its own way of behaving, and a mix of that then defines the portfolio. Now, worldwide, in matured economies, especially in Europe and all, bulk of the money for retirement goes into multi-asset structures.
Right.
And if you were to do a back testing over the last 10, 15 years, the probability of getting a median return is higher in a multi-asset structure than a single asset structure. Because a multi-asset structure holds the best asset class as well as the worst asset
one.
class together, and the behavior actually is cyclical.
Right.
So when you form a portfolio, the importance of all three asset classes being in your portfolio is given.
Right.
Please don't stick to one asset class. That is my learning over a period of time. That the sooner you graduate to all asset classes is most important. There is a return projection of each asset class, which has to be respected. Say equity, I will put at 11 to 12% over a period of time. Core equity. If you want to increase that, then you have to increase the risk profile of the portfolio. Say gold now looks at double digit also. So let's
Right.
put it at 10% and debt as say 7% to be on the safer side. A mix of this will give you the ultimate. And how you turn it around, a small Excel can tell you a percentage of that. So once you define how much return you want, then you can work backwards
Right.
on the portfolio. But my humble request is start yesterday. Because that was my biggest mistake. I did not start when I was young. So the pressure on me to invest is dramatically high now. Second, invest across asset classes.
Right. Right. Thank you. Thanks for that. Makes sense. Let's move to the rapid fire now. Few short and quick questions I'll ask you. Number one is the biggest secret of SIPs is, according to you?
I think you stay invested in the market.
Right.
You own the market.
Don't stop your SIPs.
Yeah. No, you stop it on the day you achieve your returns.
Right. Okay. Goals.
Yeah.
Right. Of course. Active or passive mutual funds?
Both.
Both.
Because post categorization, the definition of all categories are given and the portfolios are also given. This is a business of ideation. Ideation happens on the passive side.
Right.
So if you want a mix of both and get incredible stories on the passive side and mix it with some tried and tested good solid stories on the active side, the ultimate portfolio can be superior.
Right. ETFs or mutual funds, your choice?
I think a mix of both.
Mix of both.
Because there's some fantastic fund managers I want to have in my portfolio. So that, and at the end of the day, I really love the whole concept of just owning the index perpetually.
Right.
So
right.
Like I said, differentiated stories are available there.
Right.
I mix both.
Nifty 50 or Nifty 500, better index?
Used to be Nifty 50, but now Nifty 500 because of the listings that I said, the market has become broader than usual earlier. So I would prefer Nifty 500 going forward.
Right. Your first stock, and when was it? Did you make money? Did you lose money?
No, I lost money terribly. See, when you started as a mutual fund professional, you were in this misconception that you knew. But finally, market is superior to you. And then very early, I shifted to fund managers. And after I shifted to fund managers, I have not been a fund manager over a fund manager.
Right. Okay. That's good to know. One book that you personally like and, want to recommend to viewers?
See, I would really recommend people to read John Bogle as much as you can, because most of us have read a lot about active investing. Most of us have read a lot about Warren Buffett. But it's incredible for me, and I learned it a little late, very sadly, that here was Warren Buffett creating incredible wealth for people in an active format. And here was John Bogle, just on the other side, creating incredible wealth for people by owning the index. Right? It'll just enhance people's knowledge. So try and read, because I'm assuming people have read Warren Buffett a lot.
Yeah. Your role model when it comes to investing, who do you look up to, for learning, for improving your own investing game?
I think initially I was very struck by Mr. Mark Mobius.
Right. Okay.
And I've had the great fortune of meeting him. Just to think that a man could identify countries that will do well in the future is a staggering thought.
Right.
And he said something in his book called Passports to Profits. And think about the simplicities of the whole thing. He used to have his own private jet,
right,
on which he would go to countries to discover countries. And 3 statements. Think about it. Okay, the time taken from his aircraft to the cab defines the bureaucracy of the country.
Right.
Okay, when he gets into the cab, he asks the cab driver, "How's life?" This answer will define the basic social structure of that country.
Mm-hmm.
Then he checks into the hotel and goes down to the nearest newspaper vendor and asks, "How's business?" That answer will define the broad economy of the country. With these three answers, he would sit with the powers to be in that country.
Wow.
Think about it.
Yeah,
So such thoughts sort of, when I get goosebumps just
Yeah,
narrating that story.
This is quite, this is so simple, so basic, yet powerful, I think.
Very powerful. I mean,
Yeah.
look at the thought. I mean, and sometimes we complicate ourselves too much. Simplify it, and a lot of answers can come.
Right. The secret of stock market, according to you, is
It's staying invested.
staying invested. Right. So you believe in long-term investing.
Yeah, there's no other. I mean, see, you pick up any owner of your favorite company, ask that promoter, is this the best time of that stock or best time of that company? He or she will not have an answer.
Right.
When he or she does not have an answer, you are expected to predict the best 1 year or 15 days is impossible. It's like the toss of the coin.
Right.
Our job is to pick a good owner, and as a fund manager, that's what people do. Pick good promoters and take the ride with them. Sooner or later, they will unfold that value to you. If we knew that, we won't be salaried individuals.
Right.
But we can know which are good promoters. And that should be the approach to stock market.
If you were to go out on dinner with a celebrity, who would that be?
So I was trying very hard, but recently when I saw the resurgence of Virat Kohli,
Virat Kohli,
and the hunger to come back and score the way he is, I'd like to discover that hunger at this age.
Right.
It's just, I mean, on the day Sachin Tendulkar had retired, I tweeted that Virat will eat his records for breakfast.
Right.
And nobody had believed me that. But that was one side of the story. To come back and score the way he's doing now against all sort of feedback that he's got is something which I'd really like to sort of understand. I mean, how does he do it? It's just crazy to me.
Absolutely fantastic. Absolutely. Who should be my next guest?
So I would definitely say Neil Parekh.
Okay.
Neil is rewriting the entire history of mutual fund industry in an absolutely fiduciary manner. And I've said this in many forums. When I first narrated 8 years ago that they were my favorite fund house outside Mirae Asset, not many believed me, but I would say Neil Parekh.
That's a very, very good name. It's been on my list and hope to reach out to Neil.
Yeah, he's a wonderful boy, and it's fantastic to see a person at that age doing this work. I mean, the future of mutual fund industry is in good hands.
Brilliant. With that, there is a lot that I've gone through in short period of time. Swarup, thank you so much for your time. I know you've traveled here, given your time during a weekday, never easy for what you do. So from the bottom of my heart, thank you once again. Thank you so much.
I would like to thank you for this incredible discussion. I really enjoyed it. And thank you for having me as your guest.
Thank you so much, Swarup. Thank you.